Chapter 16, manufacturing accounts or manufacturers. So we prepare manufacturing accounts for businesses that produce goods they manufacture. So that's why we call it manufacturing accounts. So here it is prepared by manufacturing businesses so that the cost of manufacturing can be transferred to the statement of profit or loss and other comprehensive income. So we want to know the value of total goods produced. That is why we prepare a manufacturing account. As soon as we have the figure, the total cost or the total value of what is being produced, we transfer that amount to the statement of profit or loss account. So for manufacturing account, we have the direct cost and indirect cost. Why do we call it direct cost? We call it direct cost because it is linked to a specific unit. We call it a direct cost because it is linked to a specific department of this or factory of this. So it is linked. For indirect costs, they are not linked. They are costs, they are overheads. So it's for all the company, but we have to apportion it if it has to go with each department or manufacturing. But what you have to understand about indirect costs is that we can apportion them. But for direct cost, it's the cost for a specific unit in the organization or business. Clear? Is it clear, please?
Yes.
So we have our prime cost, which is the total direct cost, which are direct expenses, direct raw materials, and direct wages. The sum will give you your prime cost. Do you get prime cost now? In manufacturing account, we have raw materials, cost of raw materials consumed. So we have the opening inventory of raw materials, we have the closing inventory of raw materials. So these ones are direct raw materials. Then we have factory workers, they are being paid, that is direct wages. Then we have expenses incurred in the factory, these are direct expenses. So direct wages, direct raw materials, direct expenses will be added together to get our prime cost. Is prime cost clear there? So direct expenses also contains royalties. For royalties, the sum of money paid for you to be able to use designs that are not yours. It's called royalties and expenses. So here I wrote royalties, the sum of money paid for the right to use a product or process that has been invented by another business. So for you to use a business idea or process, you have to pay royalty.
Okay.
That is what is being paid. I think it's clear.
Yeah.
So if a business is paying you, if a business is paying that to you, it is an income. But you are paying to a business. It's an expenses on your own side. Is it clear? And I told you about indirect costs. They are factory overheads.
Okay.
Then we have cost center. For cost center, this is where we separate different costs. We apportion the cost to each unit. We call it cost center. Is it clear?
Yeah.
So that takes us to the format of a manufacturing account. We have the format. So when you are preparing the manufacturing account, you start with opening inventory of raw materials. On the extreme side, you had purchases of raw materials, you less closing inventory of raw materials. This is the cost of raw material consumed. So now that you know the raw material consumed, you now had direct labor, which is wages, you had it, direct expenses to it. That gives you your prime cost. I talked about the prime cost already. The first item in the manufacturing account is your opening inventory of raw materials. Then you add purchases of raw materials. Then you less closing inventory of raw materials. That gives you your cost of raw material consumed. That is direct raw materials. Then you add direct expenses, you add direct wages. That gives you your prime cost. Clear? Now our indirect cost now. We have our factory overheads. We have wages, we have indirect cost, we have depreciation, rent, rates. These are indirect costs. Yes. So as soon as you have the indirect cost, you had opening work in progress. We have our work in progress. These are goods that are about to finish. Okay. They are not finished goods.
They're working on goods.
Yeah, they are still on process to be finished. Then you less closing work in progress. Do you get it? So this, when you add it to your prime cost, it gives you your cost of production transfer to the trading account.
Okay.
So what I told you, we opened a manufacturing account because we want to transfer the cost of production to the trading account. You have your prime cost, you had all overheads. You don't less here. Yeah. You add all overheads to give you the cost of production that will be transferred to the trading account.
Yeah.
Remember, after your prime cost, your all indirect costs will be added. Then you had work in progress, you less work in progress. So the value gives you your cost of production transferred to the trading account. So this is the format of a trading account. This is the format of a trading account. Now we go to inventory. So for inventory, we have three kinds of inventories. We have the work in progress, we have the raw materials itself, and the finished goods. The raw material will be part of the manufacturing account. The work in progress will be part of manufacturing account. Then the finished goods are goods that are sold. Do you get it? So raw materials are goods purchased by the business. We call it raw materials. This is what you produce. So in the course of producing it, it takes you to work in progress. As soon as it is produced, then it becomes a finished goods, ready to be sold. Then we have our finished goods, which is fully completed goods, ready to be sold. Our work in progress, partly finished goods. I think it's clear. Then we go to apportioning expenses. For apportioning expenses, that's here, apportioning expenses. So here, the nature of the expenses will be put into consideration when apportioning it. So the nature of our expenses, we have to check which